Welcome to jimsnotes.com. I'm Jim Farish, editor and founder of Jim's Notes. It's been a while since we did a video, so I thought with tonight, based on what we're seeing in the markets right now, that versus trying to write out all the various details of what's going on, I thought I'd record a video just to make it a little bit easier to go through some of the charts. And so here we go. Let's start with the fact that where we stand relative to the S&P 500 index is a little bit disconcerting in some ways, but it's positive in others. I mean, we've got all kinds of things going on. You've got this trend line that came off of here that we've eclipsed. You've got a double bottom pattern that we eclipsed in here. You've got an uptrend that's still intact here off the February lows. And you've taken out resistance up in here. We're still failing to take out that 2100 level resistance, as well as the previous highs going back to November of 2015. So you still have resistance in play technically at the top of the chart. You've had a lot of things going on within the chart, but in and of itself, all of that said, I still think that the biggest issue relative to the markets right now is the fact that fundamentally underlying these markets is very little to like, and that kind of keeps people like myself more to the sidelines more than fully engaged in the market. If we look at the weekly chart, you can see what we've been talking about in the weekly updates quite a bit is that you've had this rounding top, and so that 2100 level is important to the rounding top. It's going to take out that downward trek that you see relative to the markets itself. So we need to take out and eclipse this high as well as this downward trend line, which we've taken out last week. And now we're trying to take out again heading into this week. You can see at the bottom the relative strength on the weekly charts have been positive, but now starting to turn a little bit sideways to down. That's some of the hesitancy in the market. Some of that's generated out of earnings. Some of it's generated relative to where we stand right now with the FOMC meeting concluding tomorrow, which we'll talk about in a second. But it's also just a lot of nervousness in the market as a whole. And so let's look at two things that we're looking at. One is tonight, which is Apple, and we'll see shortly as I record this, Apple will announce their earnings, and it's expected to show the first sales decline in iPhone sales, which is, that's something that's going to weigh on the stock. You can see that it's already weighed on the stock, but because of the size of Apple, as far as market capitalization, as far as the role it plays relative to the tech components of a lot of ETFs and other things out there, it's something that's going to weigh into this market, like it or not. We're sitting on the 200-day, or actually sitting on the 50-day, two-day moving average. We're well under the 200-day moving average, but Apple is going to play havoc with the markets going into tomorrow. There's going to be a lot of bantering about whether or not this is good or bad. How it is going to play out. All of that is very interesting as we go forward relative to the whole components of tech, because if we put up QQQ here on the chart, you can see that the NASDAQ has been struggling the last 3 trading days, which was Friday and then Monday and Tuesday of this week, holding onto the 200-day moving average. But again, you've got a topping formation in the NASDAQ. How Apple plays out will have a play into that. But you can look across the board. It's not just Apple that's weighing on the NASDAQ. You can see Google, Facebook. If you just go through or scan through some of the top stocks within the NASDAQ, you can see that there's definitely an issue relative to what's going on. The semiconductors, you can see the sideward trading motion here, so no upward momentum in the stocks to speak of, and that's an issue that is going to play into this. And if we pull this over a little bit, we can see in this top table, if we sort this by percent change relative to today, You can see Micron breaking out there. You can see Sun, which is a whole other issue, but you can see Cypress Semiconductor, On Semiconductor. So the semi's seeing a little bit of positives, and if we look off the lows, you can see that Maxim putting a little bit of pressure. But for the most part, the semis had a very good day today, but they're still kind of trading in that sideways motion, and we do need the semis to pick up some of the slack for the larger cap stocks as we head forward relative to what's going on. On the other side of this, I want to look at TLT, which is a 30-year Treasury bonds, and you can see that we had a little bit of a descending triangle pattern in here that was coming up off this upward momentum. We took that out last week, and then you can see that it's continued to fall. We're now at support levels, but the question begs what's going on relative to treasuries, and why are we seeing a rotation out of bonds? And if we go to TYX, which is the 30-year treasury yield, what you've seen is a rise in yields, and they're starting to break out to recent highs at 2.75. But you're seeing yields rise, and not only there, but if we look at the 10-year Treasury yield, you can see it hasn't eclipsed its previous highs back in the March timeline, but you definitely were up at 193, pushing back to that 2 level on the 10-year Treasury. Again, you're seeing money rotate out of bonds, and the question is why? Well, tomorrow concludes the FOMC meeting. There's a lot of things on the table. If you haven't read the Bloomberg article on the danger of bonds that was published 3 or 4 days ago. Very interesting about what's going on between the Bank of Japan and their debt, which, Bank of Japan, if you look back into January, the Bank of Japan bonds were yielding 1.4%. Those bonds are currently yielding 0.3%. Have you seen a 110 basis point decline in the central bank yields on bonds for Japan? You've seen some similar movement with the ECB relative to what's happening with European bonds. You've seen there are now $7 trillion worth of sovereign debt in the global sovereign debt market that now resides below 0%, meaning that we have negative yields on $7 trillion worth of debt. We have $45 trillion of sovereign debt that exists globally that now has bumped down to 1.2% average yield on that debt. The United States obviously being a considerable part of that, helping that yield be even at 1.29. But that's an 11 basis point drop just in the last 30 days on the long end of the curve. We're seeing 40-year and 50-year debt come out of France and other parts of Europe at basically 0% or negative yields. That's the kind of interest rate environment that the market currently exists in. And those are issues that, as we go along, that are going to continue to rattle the bond market. But think about the fact that if the Federal Reserve for the United States does hike rates in June, I doubt we're going to see it tomorrow with the conclusion of the April FOMC meeting, but if we see it in June that the Fed starts to hike rates, we could see $1 to $2 trillion worth of value erosion in the bond markets relative to just a 50 basis point move in treasury yields being sovereign debt yields across the globe. So there's definitely some worry in the bond market, and you're seeing a lot of pressure within bonds. A lot of people talking about yields going up. I'm not really sure that the bond market reflects that in any way, shape, or form currently, but it does have risk as all of this unfolds. So it's definitely something that you have to look at, respect, and kind of watch as we go forward. The other big issue on the table is the dollar. The dollar has not fared very well since the December timeframe. We can see in here that the U.S. dollar coming into today's close has fallen 6.27%, which is not positive relative to the buck. But, a lot of people want a weaker dollar so that we can compete globally for sales. I think that, you got to be careful what you wish for. I'd like to see a relatively strong dollar remain here. I'd like to see the Fed actually be a little bit more proactive, if you will, relative to yields. and take a little bit of a stand as it relates to what we're seeing in the economic cycles of the U.S. We do need to see yields go back up in the U.S., but again, the biggest factor on the table is whether or not we're going to see any significant change relative to any of that. So to summarize tonight, one of the things that worries me quite candidly is the underlying fundamentals of the market. There's nothing there that validates where we currently reside relative to earnings. If stock buybacks start to dry up, that's going to impact what you see in the earnings momentum. We've had 4 consecutive quarters. I've written about this over and over. We're now into the 4th consecutive quarter where we've seen a decline in earnings quarter over quarter, and a 5th consecutive quarter in a decline of revenue numbers quarter over quarter. And that issue still resides in the market as it relates to forward-looking growth. So I don't have a lot of love, if you will, for the S&P 500 on the upside. I think this resistance does come into play, which is why I talked about it at the very beginning. I think you got to watch how that unfolds in relation to the NASDAQ 100, which you can see here with using QQQ as a benchmark for that. This is definitely an issue. The NASDAQ is lagging. It had been a leader up to this point. Large cap stocks are struggling. That's all something that we have to look at as we go forward, because until you see a driving momentum of leadership, then those are the key issues that we all have to look at. We've seen some leadership out of the financials of late, but it's still early in that game. Large caps are not one of my favorites, obviously, for a lot of reasons relative to their balance sheets and exposure to the energy market, which unless we see crude start to escalate even more, that's an issue unto itself. So you've got the issue with the S&P earnings and revenue. You've got the Fed back into the game. That's impacting bonds. You've got global sovereign debt issues with negative yields. The dollar, the weakness of the dollar, if it gets weaker, I think that's a negative. That's one way, I guess, to get crude oil prices to go up is to continue to devalue the dollar. But that's not going to, the long of that is not really as positive as a lot of people think. A stronger dollar policy is definitely economically better. I get the export issues, but the United States, for the most part, we don't have the greatest trade relationships around the world on that venue anyway. But commodities are another issue relative to the dollar. The weaker they're going to get, that could drive as well. So if you look at the weak dollar and you look at what's going on in commodities, whether that's DBC, which is going to be the bulk of that is going to be crude oil, and you're going to have gold in the commodity index as the two heavyweights there. But if you look at DBA, which is the agriculture stocks, you can see they've been moving very volatile, but they broke this downtrend here, and you can see that they're trying to gain some upward momentum. Again, watch how the agricultural stocks unfold. You can see whether it's corn or soybean. You've seen a lot of movement, sugar across the board. You've seen some positives in the commodities as it relates outside of the oil and gold commodities, but you definitely are seeing things there. The base metals are moving, which is DBB. We've seen a movement in aluminum here. You've seen movement, even though that chart is kind of spattered volume-wise, but you can see the movement on the upside in aluminum. You've seen upside movement in copper. We've seen across the board that the base metals have moved very well. Steel has been the biggest leader there, despite the little bit of a pullback that we've had of late. But you've seen movement in the commodities. The reason I bring that up is you got a weaker dollar. That bodes well for commodities. Commodities moving higher bodes well for the emerging markets because it's their dominant resource that they're going to sell globally. So you've seen a bump in the emerging markets. Don't fall for all the trash that you hear about how the emerging markets are improving. Commodities are improving. That improves the emerging markets. I mean, whether you go to Latin America, which is a big producer of the base metals, copper, and whatnot. You can see that the agricultural commodities are moving, which has helped Australia and some of the other places. The mining stocks have helped Australia as well, where you've seen some of the base metals and other things move have helped Australia significantly. Oil moving has helped Canada. It's helped Russia. It's helped the Middle East. But you've got all these commodities moving, so their markets are moving in relationship to the commodities, not so much because of their economies. And that's something that you have to weigh into this. So it's the risk trade really relates proportionally back to the commodities. So take into account what's out there, take into account where the pieces are. But this is an extremely dangerous market, regardless of what is done off of the February lows, regardless of what people want to talk about in the positives. This is still a very dangerous market environment, and it still has a lot of pitfalls and potholes to it. So all I will say is buyer beware, manage your risk, have a disciplined strategy as to how you approach it. But don't get carried away with what you see on the charts as everything is hunky-dory, and focus on what the underlying drivers are and how they can either drive forward or how we can have the rug pulled out from under us relative to each of those pieces. So a lot of things to consider, a lot of things on the table. All I can say is I felt that I had to put some of this out here in this format just so you could hear it. Always interested in your feedback. You can always reach me at jim@jimsnotes.com, or you can reply to info@jimsnotes.com, and I'll be happy to help you in any way that I can. With that, have a great evening, and we'll see you next time.